Hi, everybody. My name is Jackson Pineau. I am the Public Affairs Manager for the Minneapolis Area Realtors, and I will be walking us through our Twin Cities market update for July 2024. Now, this is going to be data from our most recently completed month, the June housing market. We're going to walk through a few agenda items right here, just so that way you get the lay of the land of what we're going to talk about for the next 45 minutes to an hour. We're going to start things off with what is near and dear to many people's hearts, the monthly market trends, those both short-term trends in terms of showings as well as long-term trends on all of our major metrics. We'll go into some market segmentation and slice and dice the MLS data up a little bit to look at some changes in smaller segments of the market. We'll zoom back out and look at the national housing market and some demographics before shifting our gaze into the larger economy. Yes, that's where we're going to have the meat of our conversation around mortgage rates and combating inflation. And then finally, we will save time for questions at the end. You guys excited? All right, let's jump in with that market update for the June housing market. Now, one thing that I know people are keenly aware of is the relationship between interest rates and activity here in real estate, right? This is a super simplified chart that our Director of Research and Economics, David Arbit, put together, and him and I use this all the time to communicate that inverse relationship, that opposing relationship between the showing activity that you all are seeing in practice and the mortgage rate trends. And you can see here, there's kind of a crisscrossing effect happening. Let's not zoom in. We're going to use our little laser pointer here. There's a crisscross effect happening. When mortgage rates in gray go up, the showing trends goes down. When they flip, and then they'll flip back again, and they keep opposing one another. And you can see as rates have trended down to about, let's say, mid 6% here, showing trends have started to peak back up again from early June. We bring this up just to show you the fundamental basics of why our showing activity is increasing in certain areas of our metrics here. Now, what you are seeing here is part of our weekly pulse, something that we write every Monday morning, Monday afternoon-ish, with showing activity, new listings, and pending sales activity from the most recently completed week to the same week a year prior, which is what you're looking at right here. Week end in July 14th, 2024 is in gray. Week end in July 14th, 2023 is in blue, right? And you can see for our median sales price homes between $300,000 and $400,000, we're up almost 6% to about 6,500 homes that were shown last week compared to 6,200 the same week a year prior. Now, generally, overall, we are down about 4%. 24,000 homes were shown in early to mid July of last year compared to 23,000 early mid July of this year, right? But when broken out by price range, you can see a chunk of that decrease is due to decreased showings in the more affordable price points, 300,000 and below. But there's increased showing activity from that median price of home up and above all the way into the million plus category. Speaking of that activity, we know showings tend to lead to sales. The first and probably the most permanent indicator for buyer demand here, closed sales. Let's take a look at how June finished with closed sales. Yes, we are down 16% at about 4,500 homes sold in June compared to 5,400 homes sold in June of last year. And just a reminder for people, if they are new to looking at these charts, for this type of formatting, we are looking just at the most recently completed month, June, and each bar goes back to the appropriate June for each year, right? So For instance, June 2016, 2017, 2018, 2019, 2020, and then 2021, we saw that big shoot into 7,600 homes sold in June of 2021. And yes, we are seeing a 4-year decreasing trend. We know that is in reaction to a disproportionately high hyperactive market from COVID-19, right? We're familiar enough with that. I won't belabor the point on that for each of these charts, but keep that in mind. That is why we're seeing those decreases, right? Let's take a peek into a crystal ball a little bit here because we know that June pending sales will most likely become July closed sales. And you can see the trend continues here, a downward curve from about 2021 into 11% down at 4,469 homes that are under pending contract in June, compared to 5,000 homes in June of last year. Now, again, we're seeing a similar trend that we saw with showing activity here. The biggest portion of that impact, this is broken that down by those price ranges. We're seeing 35% decrease in the most affordable category, negative 23% decrease in pending sales for 120 to 150, negative 27% decrease from 150 to 190, right? Those not only are the homes less available there because there are fewer and fewer homes that are priced at that point due to regular, consistent inflation of monetary value, right? Those homes are just being bought up way faster because people can't spread their dollar as far as they used to under 3% interest rates, right? But if you go to the median and market above median market price points, you can see even the 750,000 to 1 million price range is up compared to this time last year, up at about 4%. Let's flip to the other side of the coin here and talk about supply. New listings is the easiest way to understand how many homes are coming onto our MLS at any given moment. A similar vein here, we are down 6% to 6,358 homes that were listed in June compared to 6,700 homes that were listed in June of last year. Now, this is the first time in a couple months now we have seen a decreased new listings metric for our most recently completed month. In May, we were up. In April, we were up. June, we're down. Now, keep in mind, June is one of those more prone to be seasonally hyperactive, right? These are the months where people are most likely to be willing to list their home and close on their homes. So you got to take it with a bit of a grain of salt. And as we dive into the price range breakdowns like we did, know that is not an error you're seeing all the way off in the left. I triple checked it because it looked a little odd. 120 to $150,000 homes have a 24-ish% increase in listings in the month of June, 110 compared to 80-ish that were the year prior. But apart from that one outlier, we're seeing the same general, let's call it like a parabolic shape going on, decreases in the more affordable category. We start to get to about zero as we trend above that median sales price and then slight increases, but on the whole, 4 to 5% down. Keep in mind, if you're eagle-eyed about this, this says 4.7%. This said 5.8%. It's still the same statistics. They're just taken at different periods of time, and we screen captured them on different days. But we'll get the official numbers when we release them with our official press release. These are the sneak peeks for you guys, right? Let's talk about something that's been top of everybody's mind, especially you see it in the news all the time. median sales price and how it keeps going up. And I want to challenge that notion. I mean, it's a fact. Yes, it is going up. But you hear a lot in the news about how it's more unaffordable than ever, right? That home sales are skyrocketing. And you're definitely going to hear that because we are trending closer and closer to the Twin Cities median sales price breaching that $400,000 point. We've been getting close to it. We are still under it, but I wouldn't be surprised by the end of the year if we have one point where our median sales price is at or slightly above 400,000 for the first time since we've been recording. And I want to talk about these trends that you're seeing in here because it's important to recognize the importance of why people invest in real estate. They invest because of this red dotted line, right? Because even with inflation increasing at expectedly 2 to 3% each year, you want to gain some value in your home, right? That is what equity is all about. And this red line is a super simplified way of us showing that from 2013 to 2019, we had a pretty consistent linear increase in median sales prices at about, let's say, 5 to 6%, beating that 3% inflation loss that you would get if your home just stayed the same value. In real terms, it would decrease in value by 3%, right? Because the economy grows. But that's not what happens in reality. Your home exceeds that increase in its value. And when COVID hit and all of a sudden the economy valued money less, so to speak, people traded that in for homes, right? And then the value of those homes were much higher, hence the dotted line being steeper than it was for the almost decade prior, right? And with the controlling of run on inflation, that dotted line has now curved off. And that's what we've been seeing for the past couple of years, leaving us now with a median sales price in the month of June at about $390,000. And that's only 2% up from where we were last June. Now, keep in mind, back when we were in a pre-COVID economy, that increase would average around 5, 6%. We're now in an economy that is rebounding, right? We're only seeing 2% increase. We're definitely not seeing price decreases. Yet the framing that you're seeing a lot in the media is, oh, more expensive now more than ever. It's more difficult to buy a home than ever before, right? I mean, they're not wrong, but look at the difference of the rate of increase from one year to the next and then the rebound of it, right? This is something that is natural in the economy to see median sales prices increase. It's about planning appropriately for these increases in a predictable way, right? Here's another way of looking at it, the year over year change in median sales prices. Uh, Looking all the way back, you can see the big chunk of red here was the 2009 financial collapse. We had a tax credit period, but that only stymied the loss a little bit. We then had a resurgence in 2013, and that point of stability that you were seeing is this whole area where we were somewhere between 5 and 10%, but closer to 5, 6%. And then that run on inflation, the price of homes skyrocket, drop back down. We had 2 months of negative price growth, and now we're on a return trajectory back to around 5%. That's good. That's what we're intending to have because this is the stability that our clients are looking for, that future buyers are looking for, that sellers are counting on when they eventually sell their home. Just putting all of that in context. Another important thing of context is original price list received, listing price received. The idea of giving your seller appropriate context of how much to expect when you're listing their home, right? Because prior to COVID, we had a pretty standard expectation of you might, in the median circumstances, have to negotiate from your original list price. You might have to see a decrease. You can see 2018 was slightly above 100% of list price received at the median sale. And then for 2019, it was exactly, people got exactly what they originally enlisted. 2020, it went down to 99.6%. And then in 2021, we had median 4% over asking price. You know, doesn't even speak to the other 50% of homes that were sold that were above that 4% asking price, right? We have cooled down since then. We are no longer in that type of economy. And we are now returning back to about closing on the same price point about what you ask for. That's not to say that there aren't some stories out there where people had to drastically reduce price, or that they still are seeing competitive offers that are offering 4 or 5 or 6% over asking price. That still exists. But statistically, at the median here, the 50th percentile of homes are getting about what they ask for. That is the indicator that we're looking for here. And that brings us into a conversation around, God, where are the guardrails on this thing? You know, we have heights here, we're dropping down. You know, let's shine some insight on that of it, being able to tell what is sensationalist that you're seeing in the news, and then what are the indicators that you can see that are within those guardrails that are important. And we want to talk about ceilings and floors, the idea of uh, lacking affordability, higher mortgage rates. That's what's preventing prices of homes from rising so much. Those are the things that are causing a price increase speed limit, a ceiling, if you will, right? Now, at the same time, home prices haven't dropped. I just showed you a few minutes ago that median sales price only had 2 months last year where we had negative price growth. What's the floor here? The floor is the shortage of supply, because you can't have a bubble pop if the bubble isn't filled with air, if we don't have excess inventory of which to devalue. And that brings us into our June inventory. And as you can see, if you like to think of this, I really just love the imagery of our inventory being a gas tank. 2007, our gas tank was way too full, had way too many homes, right? And then we had the financial collapse in 2009. And as we reset under new regulations, new buying, new lending regulations, 2012, 2013, that would be considered that new reset point. And our gas tank is mostly depleted since then, right? We ended June with a just short of 9,000 homes left on the market. That's 11% increase from June of last year. And that is an increase, no question, right? But it's not quite where we were at a decade ago, right? And I bring that up to say that if you look at it in terms of month supply of inventory, amount of inventory relative to how much demand we have, then you can see we're only at about 2.5 months supply of inventory. If there was no more homes listed on the marketplace, the MLS would run dry in under 3 months. Now, a healthy balance between buyers and sellers is about 6 months supply of inventory. We weren't even at that in 2012, 2013, but it was better than where we're at now. And now where we're at is certainly better than the hyper shortage of inventory that we had in 2021 and 2022. We're rebounding from that about to where we were in 2017, 18, 19, right? But we still have a little bit more room to grow and even more to get back up to a balanced market. Final indicator here for you all on the speed of the market, because I've heard a lot of people talk about how it's gotten slower, Jackson. It's so much slower than it was a couple years ago. And I can see that here. The stats show us that, yeah, homes are selling. Now, by selling in this case, I mean from listing to under pending contract, right? In 15 days at the median, half of all homes, 2 weeks. That's much slower, almost twice. Well, it's more than twice as slow than 2021 at 7, or almost twice as slow as 8 days at the median for 2022. But we're not quite where we were in the pre-pandemic numbers, right? 2018 days on market. We're not quite there yet, but we are. I understand why people say it's feeling slower, right? Now, these are all stats. Every one of these bar charts that I've shown you so far is data directly pulled from the MLS and aggregated. You all know this, but I just want to remind you that if you don't want to just get this on a month-to-month basis, but you want to get this information at your own fingertips on demand, a lot of these tools we have here on our market data webpage here at Mars website can give you that information. Things like InfoSparks can show you those bar charts with a lot more customability than what I have. Local market updates will give you geographic breakdowns. With our housing market sortable statistics can be a quick way to reference information that you need. And like I mentioned, we have our blog if you wanted to get that weekly showing activity. It's all available at the MAR website. I hope I can encourage you to go see that. We're going to jump into the market segmentation section here, but I want to just quickly look and see if I can click on this chat button. Oh, Christine, you caught a little error that David or I must have done with July 14 of 2023 and July 14 of 2024. You're right, they are one day off. I think it was just a typo on our end. Don't worry, they're drop downs for us, so they are exact dates. Yeah. I'll make sure that we go ahead and change that in our new blog. I appreciate your letting us know about that. So let's dive into market segmentation here, people. Okay. First off, we're going to look at new construction market share. Quick shift here. All this data still coming from the MLS. We're still looking at previous years, but now we are not looking at just the month of June. Okay. We're looking at the market share out of all homes sold throughout the entirety of each of these years. What share of them are new construction? An example for this instance. So you can see for 2023, all homes sold in 2023, 12.3% of them were new construction. The only one that changes for each of these webinars each month is 2024 because we advance 1 month further. So far in 2024, 13.2% of homes are new construction, which is currently exceeding where we were at for the past 8 years, from 2015 to 9 years, 2015 to 2024. New construction market share has been has increased ever since 2021, which makes sense, but it surpasses oh no, sorry. I was going from the last divot down there at the bottom. Higher than it's been in 2007. So, I mean, almost 2 decades at that point. Let's take a look at more beds. This is the same type of methodology we're talking about here, but this was an indicator for us. We created at the start of the pandemic. We knew that because of the increased work from home activity that was happening, we'd probably see an increase in people selling larger homes. So this is looking at homes that are 4+ bedrooms. And you can see prior to the pandemic, it was about 40% of market share. increased sharply to 42%. And I got to be honest, I thought this was going to be one that would increase year after year. And no, it went down for what, 1, 2, 3 straight years. And only so far in 2024 are we starting to see a rebound back up. So if you had also noticed that, okay, larger homes are selling in 2020, but have since decreased a little bit, it might be worth looking into to see if they're back on the rise a little bit, because so far in 2024, 41% of homes sold were 4+ bedrooms. Townhouse condo is kind of the other side of that, right? The flexibility in smaller scale living, more dense population, and lower price point, right? This is a good indicator for us on the flexibility people have on their property type, whether single family, townhouse, condo, or the three majors that we look at, right? And you can see with the increased uh, addressing of run-on inflation and increased mortgage rates, you started to see an increase in people's uh, propensity to purchase townhouses or condo. Market share of those smaller property types increased from 24.7% in 2022 to almost 27% in 2023, has since backed off a bit so far this year to 26.5%, which makes sense, right? We had 7-8% increase, or 7 to 8% mortgage rate interest rates here in 2023. We're now hovering at high 6%, low 7%, depending on who you ask. That makes sense that we've ticked down a bit. Cash sales. This is continuing to fascinate both David and myself around the increase of cash sales as a market share of home transactions. 17% of all homes sold in the Twin Cities so far this year have been sold in cash. That's about the same where it was last year. But the interesting part is, as we have come out from 2020 into 2023, that was both one, talk about different market drivers, right? One, because people had more money, their money could reach further than it was. You started to see an increase in cash sales. And then when the Federal Reserve did their thing and they started making it more difficult to separate from your money, right? Then all of a sudden, there was a different incentive structure. Rather than take loans out at less enticing interest rates, pay with cash. Yet what you're seeing here is a continuous increase. Very interesting, right? Cash deals as a percentage of all sales shows you that it's not just the most affordable homes, it's not just single family homes in the luxury market. The overall market is seeing an increase. Condos in green are seeing an increase all up until the recent year. We're at about 23% there. Same thing with townhomes and condos, both went down a little bit. My apologies. Condos are at 40%, townhomes are at 23%, and single family units are at, let's say, 14% increase. Now, shifting gears a little bit here, because we've been talking about price changes, right? The availability of certain priced homes in the marketplace, right? This is an oldie but a goodie that I think in recent years has shifted, and I wanted to acknowledge it because it is worth showing a potential difference in the market dynamics between our two urban cores, right? We have St. Paul in red, Minneapolis in blue, the Twin Cities region as a whole in gray. And what you're looking at is the market share of active listings priced under $250,000. David likes to call this the disappearing act of the affordably priced homes, right? And you can see the general trend in gray here is ever since 2012, where we had a market share for the Twin Cities overall at about 70%, we've decreased down to 13%. And that decrease even sharpened as we started to get that economic pressure from the Federal Reserve from 2022 into 2023 and so on. But look at what happened in 2021 into 2022 with Minneapolis in particular. It did something different from the Twin Cities overall. It did something different from what you're seeing in St. Paul. And that speaks to the uh, the pricing characteristics in different urban centers, in different municipalities, different types of housing stock, at least at a different price point, right? The the increase in active listings as a market share increased for a full year, let's say almost a year and a half in Minneapolis, unlike the rest of the Twin Cities, unlike St. Paul. There was an increase there. Yes, it has since been curved, right? But that is worth noting, that activity. And that also means that that activity was purchased. People were purchasing those affordable homes in an urban core at a higher rate than they had in the previous 4 or 5 years. Really interesting stuff, right? Now, that's what I have for you in terms of just our data of market segmentation. We're going to dive into the housing market at a national level quickly, and then we'll have a continued conversation about some of the implications of that, what that might mean in terms of mortgage rates, and help you and your clients understand what those dynamics are at play in the future. If you got any questions, now's the perfect time to ask them, and go ahead and put those in the chat while I bring you to the most recently available housing report from Lawrence Yun and his team at NAR. Now, I will say this is a month old because they have adjusted their timing that they release these reports. They used to do them the day I would make this webinar. They don't do that anymore. If you want June's housing market report at a national level, it's coming out next week, not this week, unfortunately. But I got you May's housing report. And overall, in the United States, the number of sales has decreased almost 3%, but not everywhere. In fact, Midwest is up 1% compared to Northeast being down in sales 4%, the South being down in sales 5%, and the West being down, and they're normally never down, 1%. So gold star for the Midwest. I love the fact that we can be leading the way in terms of number of sales. It shows that our economy is an enticing one compared to the year prior, unlike what you're seeing in these other regions. They have, obviously, we're painting with a broad paintbrush, but if we're getting into a little bit of like region competition, we're ahead, right? Not necessarily the same story. I guess it's everybody's a winner when it comes to housing prices. Nationwide, we're at about 5.8% for housing prices. Now, this is just existing homes. This is not new homes incorporated into this number, so keep that in mind. The Northeast is leading the way at 9.2% increase in their housing prices. The West and Midwest and South are still positive, just not quite as much. We are second with 6.4% increase in our housing prices, then the West with 5.5%, the South with 3.6%. So best of both worlds, right? We have the highest percentage increase, in fact, the only increase in sales for each region, while not having the highest housing price increase. Sounds like a win-win to me, right? Some takeaways from Lawrence Yun. He had two sentiments that I do want to communicate to you all. His first quote: increased housing supply spells good news for consumers who want to see more properties before making purchasing decisions. And I definitely see where he's coming from on this, right? Because in 2021, 2022, we were saying, hey, make sure you have your stuff together. get yourself a realtor. Make sure you're making the best decision, the first decision. Make your offers, with information quickly. And now there's a little bit more breathing room. So that is a consolation of less demand, is that those who do choose to go out and shop with you are doing it with a little bit more time to breathe. On the point of home prices, he says that they're reaching new highs and are creating a wider divide between those owning properties and those who wish to be first-time buyers. I think that's fair sentiment to be said. We kind of talked about that. But also he adds that the mortgage payment for a typical home today is more than double that of homes purchased before 2020. That's because of interest rates, right? Now, still, he continues to say, first-time buyers in the market understand the long-term benefits of owning. And I think he is aware that it is a struggle, right? Uh to get to that price point, of being able to make the monthly payments. But still in time, he's making the same argument that I made to you with that red dotted line. Long-term investment is the main game that we're all in here, right? And that's the huge incentive. It's not for a couple years. Yes, the market will ebb and flow like it has been, but it's about decades. It's not about, oh, is this year good or not, right? Speaking of which, let's talk about home price forecast. What we said, we were up 2% in our home price for the month of June. And that has been the lowest in the past couple months. Sometimes we were up in May and April around 4%. These were the predictions that came in from the various sources down here at the bottom, averaging at about a 2% home price forecast for an increase nationwide, mind you, right? Largely, apart from realtor.com, they're all in the ballpark, right? We've seen some months where we're seeing a 4% increase here in the Twin Cities. We've seen some months like ours that were at about 1.8, right? But this is an indicator that the Federal Reserve has done their job appropriately. They're continuing to do the right job to control inflation, but not by sacrificing other sections of our economy that put us into a negative spiral of deflation, right? And as we continue into the future projections, you can see this one from HPES made in the final quarter of 2023. We have 2.3% as a projection in this year, which again, we're on track for, and it increases back up to what we were expecting nationwide. And again, we could see a similar thing here in the Twin Cities at about that 4 to 6% increase as we truly get out of the after effects of run on inflation in 2021 and 2022, right? Let's talk about first-time buyers because Lawrence Yun mentioned it, and I think it's important to kind of talk about some of the demographics around this from a nationwide perspective. And keep in mind, for almost all of these, we are talking nationwide now, right? You can see a general trend from 2011 down to where we are now in 2022, 23, a general decrease. Not massive, not huge, but a general decrease in the percent of first-time buyers out of all buyers nationwide, right? 2023, a third of all buyers were first-time buyers. Now, back in the late 90s, that was 42%. That seems to be a more stable long-term projection. And we have seen a decrease in the share of first-time buyers really ever since we saw the after effects of the market crash in 2009, right? Same story here, median range of home buyers You can see here, this is NAR's data. This is looking at, again, their median age. First time buyers here in that darkest blue line is 35. That means that we are looking at the millennial gap. I honestly don't know why NAR chooses to stick with the idea that they're called Gen Y. They've been called millennials for a while. But anyway, they've split it up into younger millennials and older millennials, right? Older millennials is right in that median age group of individuals buying their first home. And yet, I'm sure a lot of you see stuff on social media, stuff on the news. Oh my God, it's so unaffordable. There's no way millennials can ever afford a home. And who are they pointing to, right? They point to this perceived idea that baby boomers bought a home in 1982 for the price of a car nowadays, and yeah, it was a 14% interest rate, but your income was so much higher proportional to your home, and now you're sitting on it. And this stat here from Apartment List shows us that seniors aging in place own a growing share of U.S. housing. In 2021, that was 17%. And I am sure in the past 2 years or so, it has not decreased. And that is the ongoing narrative that I'm sure you are seeing. Why is that happening? NAR provides a little bit more insight here in their 2023 report showing that, look, prior to the financial collapse, the median seller or median homeowner stayed in their home for about 6 years, which is always surprising to me, right? In my mind, I think, well, this is a long-term investment. You're staying there for a while, but no, median seller tenure was 6 years nationwide. And then all of a sudden, boom, post financial collapse started to become 8, 9, 10 years. Do you notice something around this trend? It's inversely related to one of those earlier charts that I was showing you about the share of first-time buyers, right? People are just staying in their home longer. It's a shift in our housing economy, right? That doesn't prevent the perception, right, of unattainability from millennials. Some of you have seen this before already. Again, Apartments List showing you that the number one reason millennials say that they'll rent forever is they cannot afford to buy a home. And that's increased from 70% in 2018 to, let's say, 75% in 2022. And yeah, gosh, even just the past 5 minutes of me talking like this feels like it's some sort of sitcom of memes of millennials and boomers pointing at each other. Gen Z's crying. Gen X is dealing with it as best they can. But let's shift into the realities around this, okay? And not feed into this type of mentality. Here's a fun little report from National Association of Realtors that David and I dug up. Millennial home ownership rate. Grand Rapids. Now, again, 2021. Okay, so we're a little dated here. Grand Rapids, 63% of millennials owned a home. Minneapolis, 60% of millennials owned a home. That's above areas like Cincinnati, St. Louis, Pittsburgh. US average, just over 50%. You're in an area of your business where this may be a sentiment, but it's not the business norm, right? There are some other charts that we're going to show you about this in the wider economy. And again, another perfect opportunity. If you want to ask some questions, my eyes on the chat right now. And it will be as I continue into something I know you all want to see. Average 30-year mortgage over the past 12 months. We are currently at 6.89%. And you can see that there was a peak in mortgage rates at around 7.8%, dipped down to about 6.5%, and we have slightly increased with a little, back and forth. And this is something that I want to bring up, the highs and lows of all of this, right? Because we're looking at, even in a 1-year context, we're looking at slight variations of a larger curve. That curve kind of looks like this. You've all probably kind of heard this before in some vein, but let's put it in the context of what we're talking about here in real estate. We had a point of stability, right? And that started off a huge expansion from nothing to phase two, right? And we started actively selling things on the market, right? And then that restriction from the uh, restriction from being able to buy at such a low interest rate caused us to recorrect, right? We were going into that lull, and then we are going to be coming back out of it. Now, to put in a little bit better of a context here, it's cyclical, right? We have an oversupply relative to our short term. We then have a recession, a recovery, an expansion. This happens in waves. One of your colleagues one day told me, Jackson, I'm not too scared about what's happening with the housing market because I sat through the 2008 housing crisis, 2009 housing crisis. Um, and I learned then that it may be a different size wave, but some sort of wave always happens once every 7 or 10 years in this sort of economy. And you know what? They're kind of right. Here's the 20-year high that we're experiencing in the most recent, 2 years or so. And yeah, this is that wave. It's inverted. It's inverted from what we were seeing in the charts prior, but it's that same wave and the rebound that's happening because of it. And eventually, in time, those mortgage interest rates will go down to something that we were seeing before. Now, will they be at the 4% average that we were seeing in 2014 through 2018? Probably not anytime soon, right? But they are going to come down. And the conversation you're going to have with your clients is, you know, if you are one of these 93% that are having that currently hold a mortgage that is below what the national average is right now, are you going to choose to stay married to your mortgage? Or are you going to choose to go out and shop around for a house that fits you better, that move up house that you've been looking for? And that disincentive has worked, right? Here's another way to view the control of inflation, right? Resi Club here frames it in the light of home sales, quote unquote, lost, right? That could have been made due to the rate lock-in effect never actually happening. And this is something that, yes, that 25,000 unit loss looks intimidating when you're looking at Minnesota. But let's zoom out, right? Let's look at where this effort to curb run-on inflation has really been impacted. It's in major economies. Keep in mind, California, if it was its own country, would be in the top 3 or 4 countries in terms of gross domestic product. They're the states that are contributing most to that run on inflation. So therefore, they're the ones that lost, quote unquote, as this chart is saying, right? These are the markets that need to be recorrected. Us as well, right? But not nearly to the same degree. Mortgage rate projections, as we did with home sales projections here, you can see from December of 2023, we assumed that mortgage rate projections would be 7 to 6.5%, right? January of 2024, they got a little bit more optimistic, right? It looks like the initial projections in December of 2023 from Fannie Mae are a little bit more resembling of what we were seeing in our nationwide economy right now, right? Another way of looking at this is from Lisa Sturdivant. A 30-year fixed rate mortgage average rate. Yes, again, that peak to 7.5%, 7.8, so says Fed in the end of 2023. But she forecasted a decrease, not to the same degree, but we have gone down, right? Now, unfortunately, it's looking like the rate cuts we were expecting. We were expecting 6% rate cuts to hopefully incentivize the further decreasing of these mortgage rates. Latest reports show that it's only going to be 1 to 2 rate cuts this year at most, right? So let's keep those expectations for your client in mind, because the long-term goal here is a soft landing back to 2% inflation of our dollar year over year, right? And we're just not quite there yet. But again, about setting expectations, this is a great thing David found that I wanted to share with you all. 1971, the interest rate for a mortgage was 7.3%. If you waited for interest rates to go down, you wouldn't have purchased a home until 1993. You would have felt stuck in your property for 22 years just because the interest rate and waiting for it to go down. Meanwhile, the value of that real estate almost quadrupled nationwide. This is your argument, right? This is the biggest incentive to combat the idea of high interest rates, right? Buy the real estate and wait. Marry the house, date the rate. Some examples here for you. I know I showed you this in last month's webinar. Look, we are at 7% right now in 2024. It just looks high because the last 2 decades were so low. Those are the very enticing outliers, but I'm sorry, those are in the past, right? We got to adjust to the practice that's happening right now. And I get it. It's easier said than done, right? Historically low rates at one point had partially offset price gains in homes. This shows you that, where principal, interest, taxes, and insurance all together, with a few assumptions made by David and myself, show that, in 2020 and 2021, the median homeowner could afford the median priced home for about $1,700 a month. And then after our efforts to combat interest rates, it's $2,700. That's a $1,000 a month increase for the same priced home for the same median family income, right? But again, let's put that into context, because if you look at it in terms of the share of that median family income, it's still under what the federal government deems as an affordable price for a home. And remember, some of you were thinking, whoa, Jackson, affordable? Not quite. Don't say that. It's because in the grand scheme of things, areas like Florida, California, Texas, New York, those shares of median family income, it's so much higher, right? That 25% is affordable in context. As you can see here, percent of median household income spent on mortgage rates, we're in a pretty light gray region of the country, which is why you're seeing price growth, what we were seeing at national charts, but increased price sales as well. I only got another minute or two here for you, so we're going to go fairly quick through these. If you have any additional questions, I'll look at the very end, but I do want to be respectful of your time. Share of home financing types by year. This is looking just at Minneapolis data, and you can see the predominant norm is still conventional, yet FHA loans are increasing ever since conventional mortgage rates are going up, right? Sticky inflation, Fed is aiming for 2%, and you can see we are still holding on at 3%. Big contributors to that, what we were just seeing in all of those maps: real estate in the coasts, California, Florida, and Texas area. are preventing that, as well as wage growth. People got a lot of raises and employers have stuck to that. And some may view that as a good thing, but it is contributing to not reaching our target inflation. A final note here, just to sell the point: recession does not equal a housing crisis. Just because we saw a big decrease in home prices in 2008 does not mean we saw the same thing in 2020. In fact, we saw price growth. I'm sure all of you who have been here for the past 4 years saw that yourselves. Keep in mind, unemployment here is pretty low. We are fifth from the top here, tied for fourth at 2.6% unemployment rate. And that is something that you want to keep in mind, because your clients have are more likely to have more money to put onto the table. And relative to other parts of the country, yes, wages have gone down in some degree, but look, that price increase, we're still above where we were in 2020, relatively higher. That's a good sign for us in the long run, right? So that's what I have for you. I'm happy to answer any questions. Go ahead and throw them in the chat.